Welcome to my channel. I'm Scott, and in this video, I'm going to walk you through the process of learning about capitalization rates, cap rates. So what is the cap rate? Well, the equation is NOI, net operating income, over the current value of the property. It's a really common ratio for people who work in commercial real estate. It helps you identify your potential return on an investment. But like any metric, you want to compare it to similar properties. That means you want to compare your cap rate to the cap rate of similar properties. So to expand on cap rate a little more, it's the rate of return expected to be generated on a real estate investment. It's not meant for your personal residence. It's for an investment. And the numerator of the equation, NOI, net operating income, that's the net income the property is expected to generate. Most people would use the prior year's NOI. But if you think the future NOI will be different, or if it's a brand new property, you might want to use a different number. And the bottom of the equation, the denominator, is the value of the property, the value today. Not the value 10 years ago when you bought the property, today's value. It also helps you determine the exit rate or terminal capitalization rate for the property when it's sold at the end of the holding period. You never want to use just one metric when evaluating an investment. You would use a cap rate and combine it with other information. There are some setbacks to the cap rate. It does not take into account leverage, the debt on the property, time value of money, and also future cash flows from property improvements, like if you have to put a new roof on a property. Most people use the cap rate to assess the profitability and return of a real estate investment. The cap rate assumes you purchase the entire property with cash, and it's a yield over a 1-year time horizon. It's the property's intrinsic, natural, and unlevered rate of return. Unlevered means no debt. Leverage is debt. So once again, the formula is NOI over current market value. NOI is the income generated by the property less expenses, so less taxes, insurance, and maintenance. So that includes all regular upkeep to maintain the lawn, pay for insurance. You always want to use the current market value. Some people use the value of the property when they purchased it. And if you purchased a property a long time ago, that can vary widely. Sometimes it's hard to get the current market value for commercial real estate. It's not as liquid as residential real estate. With residential, you can just look at a similar property that's sold in your neighborhood. There might not be as many options with commercial real estate. So what can the cap rate tell you? It lets you know the duration of time it will take to recover the investment on a property. So a cap rate of 10% indicates it will take 10 years to recover your investment. And if you just look at the equation, NOI over value, that tells you the more rent you take in, the higher your cap rate. Let's talk about the limitations of cap rate. It's really only useful for properties that have stable income. It's not that useful if a property has irregular income or inconsistent cash flows. So if you have an apartment building with 100 tenants and it's 90% occupied, that's pretty stable income. And some people do prefer a discounted cash flow model to measure the returns of an investment, not the cap rate, because you're assuming the income will remain stable. And like I said earlier, if it's only 1 or 2 tenants, it might not be that stable. But when you have a lot of tenants, like hundreds or thousands of tenants, it's much more likely to have stable income over the long term. And it doesn't take into account future risks, such as depreciation and changes in the rental market. There have been some cities that were renting out apartments at $2,000, and then a couple decades later, you can't even rent it out for $500 because nobody wants to live there. So you should always take into account these risks when looking at cap rate. So people often ask me, what is a good cap rate? Well, there's no single number that's good. You have to consider your risk appetite, because if you have a low risk tolerance, then just invest in bonds. So the higher the cap rate, the higher the level of risk. And on the flip side, the lower of cap rate indicates lower risk, but lower returns. So usually between 5 and 10% is considered good or normal. But if it's lower, like 3-4%, that's pretty low risk, but it could take you a long time to recoup your investment, 25 years. You have to consider the market you're investing in. If it's a really popular place, like Boston, New York City, there's not as much risk. But if it's in a small town, a small up-and-coming town, that could be a bit risky. So what types of things affect the cap rate? Well, location is a big one. If your property is in a high traffic area, that should provide you a little more comfort And properties that are in large, well-developed areas tend to have lower cap rates due to competition from other businesses. And the local market growth is something to take into consideration. If there's a town with, say, 10,000 people, and they just added a bridge that connects to the major city, and they also added a university, a hospital, the future looks bright for that town. Of course, you want to look at how much capital you will invest into that property. If you buy an apartment building and fix it up, make it look really nice, that could attract higher rents, which is higher income, higher cap rate. Let me give you an example of how it works. Say you have $1 million to invest. You could buy T-bonds, zero risk, and get a guaranteed 3% return. Alternatively, you can invest in commercial real estate. Say there's a building for $1 million, and you talk to the current owner, and he says in the past 12 months he received $90,000 in rent from his tenants. Say there's 10 tenants, $10,000 each, but one spot's vacant. So 9 are paying the $10,000 of annual rent. And then you ask the owner how much money is taxes, insurance, and maintenance. And he says $20,000. Taxes are $8,000. Maintenance and insurance is about $12,000. So now you know your NOI, net operating income, is $70,000. $90,000 minus $20,000. And if he wants to sell the building for $1 million, the cap rate is $70,000 over $1 million, 7%. 7% is a lot higher than 3%. That extra 4% is the risk you're willing to take by investing in this property. Is it worth it? If you think it's worth it, then you may go the commercial real estate route. If you don't think it's worth it, then you might just go with T-bonds. I'll show you how easily the cap rate can fluctuate. Remember in the previous slide, the cap rate was $70,000, that's an NOI, over the current value of the property, $1 million. $70,000 over $1 million is 7%. But what if a few tenants move out of the property? And now your income goes from $90,000 to $40,000, because previously I said 9 out of the 10 tenants are paying, and they pay $10,000 for the entire year. The way we got $70,000 was $90,000 for rent minus $20,000 for taxes, insurance, and maintenance. But if a few tenants move out and your income is down to $40,000, now your cap rate is $20,000, $40,000 minus $20,000 over $1 million. It's down to 2%. And you're taking on all this risk for 2% when you could have received 3% with zero risk T-bond. Let me give you another example. Say you continue receiving $90,000 of rent from your tenants, but maintenance and taxes go up to $50,000, from $20,000 to $50,000. Now your cap rate is $90,000 minus $50,000, $40,000 over $1 million. Now it's only 4%, barely higher than the 3% T-bonds, and you're taking on a lot more risk. Another thing that could change the cap rate is the market value of the property. It goes from $1 million to $800,000. So now your cap rate goes down to 8.75%, $70,000 over $800,000. There are plenty of factors that can change the cap rate. The age and location of the property, the type of property, could be multifamily, office, industrial, retail, etc. Cap rates vary widely between these types of properties. Also, the tenant's ability to pay rent. What if you have some tenants on the verge of bankruptcy? That could affect your income and your cap rate. You want to look at the terms of the leases. Are people locked in for many years, or are some month to month? You also want to look at macroeconomic factors, the overall market in that town, what type of property it is. Are more and more people defaulting at similar shopping centers? And you want to look at factors that could affect the businesses. Say, for instance, the default rates for gyms is getting pretty high. People are working out at home now. And if your biggest tenant is a gym, that could affect your cap rate. So to summarize, cap rates are generally in the 4 to 10% range, depending on a lot of factors. But there's no one number that's good or bad. And cap rates are viewed as a measure of risk when investing in commercial real estate. So you can't say a higher cap rate is better or a lower cap rate is better. A lot of it depends on the risk appetite of you, the investor. Generally, the higher cap rate, the higher the risk that investment is. And the lower the cap rate, the lower risk. So some people ask, what's the difference between cap rate and ROI, return on investment? Well, ROI is a potential return of an investment over a certain time frame. The cap rate will tell you the return on investment currently and what it should be in the future. So cap rate is used to measure the profitability of commercial properties, commercial investment properties. So you don't want to just rely on a cap rate. There's a lot of other metrics to consider when investing in commercial real estate. I hope you learned something new. Thanks for watching.